Now, very quickly, the limited partnership used to be the cleanest, best, most often used legal entity in Texas to hold real estate, particularly substantial portfolios of real estate. And the reason was limited partnerships didn't have to pay any franchise tax. So one of the ways to avoid paying franchise tax was simply to buy and operate your business as a limited partnership. That's been taken away from us since 2006, when they added the limited partnership to the list of entities that have to pay franchise taxes. Limited partnership has to have at least one general partner who's going to have general liability. Well, okay, but that partner can be a separate legal entity that is minimally capitalized, and so that can be an LLC or a corporation. Then it has to have at least one limited partner. The good news is the limited partners have no personal liability for the liabilities of the limited partnership, but they are not allowed to be involved in the management of the limited partnership. And the really good news is creditors of those limited partners can't succeed to their limited partnership interests. They are not going to be allowed to, as an assignee of the limited partnership interest, they're not going to be entitled to vote or to control the limited partnership. So it is one of the very, very best asset preservation planning vehicles to use to keep the assets of a particular investor from being reached directly by their creditors. A charging order is an order from a court that says, okay, limited partnership, if you're going to pay any kind of distribution to the limited partner, the creditor is going to get that distribution as a result of this order, this charging order. It's an order to the limited partnership that anything that's going to get paid goes to the creditor. But guess what? The general partner gets to decide if, as, and when there's going to be a distribution. So the creditors can be incredibly frustrated by their inability to ever collect from the limited partnership anything other than distributions. And the property that's in the limited partnership can't be reached by the creditor. Then finally, if you're going to form a limited partnership, and there are certain circumstances where it might make some sense, there's a $750 filing fee, and it's usually a lot more expensive in terms of legal fees, and you still haven't avoided the franchise tax. So it's not as widely used. There are times when a limited partnership can hold non-income producing property like land and take the position that they are passive investment vehicle and escape a franchise tax. So there may be limited situations in which you want to use a limited partnership to hold title to property that's going to be held over a longer period of time and avoid having to pay a franchise tax. Unfortunately, the securities laws with respect to the sale of limited partnership interests almost certainly will apply, because the limited partner by definition can't be involved in the management, so it certainly seems to fit the definition of an investment contract, expectation of profits to be derived solely from the efforts of others. Now, one of the interesting variations on this legal entity is that sometimes the limited partners are actively involved not as limited partners but as officers of the corporation or the LLC that's the general partner. So they do indirectly what they're not allowed to do directly as limited partners. They step in and act as officers of the corporate general partner or limited liability company. All right, very quickly I'm going to have a checklist of limited liability and what's limited and what's not limited, and so I've listed that. I've left Delaware, Nevada LLCs and corporations on the list. Even though I don't practice in Delaware or Nevada, I don't generally recommend to my clients that they form legal entities in Delaware or Nevada and then turn around and come down to Texas, because they're going to have to pay $750 to register to do business in Texas. And they may have a liability for Texas franchise taxes. So there's an extra cost and maybe no extra benefit. But anyway, this is my chart for limited liability. Now, if it's done correctly, only the entity is going to be liable and the liability is going to be limited to the assets of the entity. Now, that means if you go out and buy a $2 million apartment complex and you hold it in limited partnership or LLC or corporation, the equity, assuming there's no debt on the property, that equity is still potentially susceptible to being taken by creditors to the extent that insurance proceeds aren't going to protect you. So the assets of the entity are always at risk from the liabilities of the entity. You're going to have to pay franchise taxes and keep the legal entity alive. You don't pay your franchise taxes, the franchise elapses, and now there's no longer a limit of liability. You're going to have to pay the trust fund portion of employment taxes that are withheld and any sales taxes. So just because you're a corporation and you're a president or an officer or a director or a manager of an LLC, normally you wouldn't have any liability. But if you have knowledge that 941 taxes have been withheld from an employee's paycheck and you decide to make any other payment to any other creditor instead of the IRS, you can become 100% penalty is what they call it, personally liable for the taxes that were taken out of the employee's paychecks that were never paid to the government. Same thing can be true of sales taxes. You charged your customer 8.5 cents in sales taxes. You took that money in trust. If you then turn around and don't pay it to the state sales tax comptroller, you can become personally liable for those taxes. And then obviously you got to watch out for personal guarantees. You turn around and personally guarantee a loan or a lease or the performance of a contract, you're going to become personally liable even if you're contracting in the name of the LLC or the limited partnership or the corporation. And some trade vendors are very tricky. They gladly put the name of the legal entity up on the line where they're contracting, but somewhere in the fine print it says whoever's signing this document is going to become personally liable for the performance of this contract. You're going to have to read the contract and see if that's the case and try to negotiate for removing that personal liability. It's just something that is important for you to look out for. And then, as said previously, you always sign your documents in your capacity as an officer of the entity and always include the company name in your title. Now, you still got some other duties. You got to treat the legal entity as separate from its owners. You can't commit personal torts, engage in fraud, commit crimes. So, you know, you go out and you own a piece of property as an LLC, but the LLC doesn't mow the grass. When they come along to issue the citation may be issued in the name of the legal entity, but they're going to serve the manager or the registered agent, and they're going to expect that person to show up and account for the theoretical criminal violation, and so you may still have some liability for crimes. And then finally, you can't simply transfer property in and out of legal entities and escape the argument that you have transferred those assets to hinder, to delay, or defraud creditors. So here I am, I've got $100,000 in cash. If I transfer $100,000 in cash into an LLC, the LLC owns the $100,000, but if I didn't get anything in return other than my membership interest in that LLC, and if I transferred it in at a time that I was either insolvent, or if the transfer rendered me insolvent, or if I did it to hinder, to delay, or defraud existing creditors, those are going to be considered badges of fraud, and the remedy of the creditor will be to sue the party to whom I transferred the money, i.e. the LLC. So timing has something to do with this. If you don't have any liabilities now and you move the assets in there and you don't have a liability, then there's no badge of fraud. You weren't intending to hinder, delay, or defraud the creditors, and if it didn't render you insolvent, then there's not a badge of fraud. But if on the eve of the execution of the judgment you try to put your property into the name of an LLC or transfer it to your brother-in-law, the law comes along and says, well, wait a minute, it just isn't that easy. We're going to give the creditors the right to sue the legal entity or your brother-in-law.
Gotcha. All right, let's stop and let me shut it down, and we'll keep or do you want to?
I got very quickly. I'm just gonna. This is a chart that's simply the list of tax considerations, the kinds of forms that are filed, the costs of formation, the hard costs, and then finally, this is what you can typically expect from me in the way of estimated attorney's fees. I have an asterisk by virtually all of them because I'm assuming that there's only a single investor that I'm representing. If it's a multiple legal entity or a multiple investor transaction, then I'm going to have to go on the clock at my hourly rate. But the franchise taxes, I'm listing those issues very quickly as well.
Well, let's do this. I want to spend another 10 minutes.
Okay.
So let's go back.
Well, this will end this section. Okay. So the cost of operation, obviously, if you're not the registered agent for your legal entity, you may have to pay a fee to your registered agent. I'm free for the first year when I form a legal entity, and then I charge $125 a year to serve as the annual, as the registered agent. And most registered agents who are serving on behalf, you have to have someone who has a physical address, who will agree to accept process, who has an address in Texas. Right. You may have to pay legal fees to an attorney or to an accountant to pay your tax forms, and then more importantly, one of your costs may be you may have to pay higher interest, or you may have to pay higher insurance costs, because the best interest rates and the best insurance typically is available to an individual.
So you're talking about loans.
I'm talking about a loan.
You got to go to a different lender, or possibly a lot of the Fannie Mae and that type of product is not necessarily available to an LLC and limited partnership.
Or a corporation. Now, some of the loans they'll purposefully make to a limited partnership, like the Fannie Mae multifamily properties, but of course you got to have a lot more cash to put down. And so that's essentially where we stop with respect to the costs and the issues, and then we'll pick back up going through more carefully and in more detail in the next segment what a limited liability company is, how it works and operates, because it is the most popular legal entity in today's world.